Hello everyone, I'm Van Kiet Luong. Today we are going to explore a trading technique known as the pocket pivot buy point, a strategy for getting in early by following institutional footprints. This method was developed by Gil Morales and Chris Kacher, two traders who worked directly under the legendary William O'Neill. It was presented in the acclaimed book Trade Like an O'Neill Disciple, published in 2010. What makes this technique special is that it's not a theoretical idea, it's a battle-tested tool that Morales and Kacher used to generate 18,000% returns in the stock market. First, let's understand the essence of a pocket pivot. By definition, a pocket pivot is an early breakout signal within a base, helping identify a valid buy point before the stock breaks out to a new price area. Why do we need such a tool? Consider an important reality. Large institutions and investment funds do not like buying stocks at traditional breakout points. They prefer buying at the price levels that they find attractive, and their buying activity is what shapes the bottom of the base. So if we can read the signs of institutional accumulation right at the bottom of the base, then we can enter alongside smart money at a lower price and with lower risk. That is precisely what pocket pivot achieves. This technique gives us earlier entry, get in ahead of the crowd 2 to 5 days before the traditional breakout, lower risk, a profit cushion to weather corrections even if the breakout temporarily fails. Institutional confirmation, volume cannot be faked. It confirms smart money is entering. Now let's get into the specifics. A pocket pivot has 5 core conditions. First, price must be above the 50-day MA. Except in rare cases, such as a market recovering from a severe crash, a pocket pivot is only valid when the stock is above the 50-day moving average. This is the dividing line between strength and weakness. Second, the volume condition, the heart of the method. Volume on the pocket pivot day must equal or exceed the highest down-day volume in the prior 10 trading sessions. If volume is erratic, extend the look back to 11 to 15 days. Third, price action prior to the pocket pivot must be quiet. Right before the pocket pivot, we want to see tight price movement and drying up volume. Then the pocket pivot day bursts higher in both price and volume, a clear contrast to the preceding days. Fourth, the base must be constructive, tight weekly closes, no large swings with evidence of institutional accumulation within the base. Fifth, avoid wide loose bases. Pocket pivots within wide and loose bases fail more often because there is no systematic accumulation. Let's see how a pocket pivot works within a base. The process typically unfolds in 5 steps. Step 1. Stock forms a base. Cup with handle, flat base, double bottom, classic O'Neill base patterns. Step 2. Institutions accumulate at the base bottom. The base bottom is formed by quiet institutional buy-in. We recognize it by spikes in volume at the bottom while price does not drop further. Step 3. Price becomes quiet. Volume dries up. Price range narrows for a few days. This is the silent accumulation phase. Supply has been exhausted. Step 4. Pocket pivot appears. Price surges above the 50-day MA. Volume explodes past the highest down-day volume of the prior 10 sessions. This is when we enter, not waiting for the breakout. Step 5. A few days later, traditional breakout occurs. Price breaks above the base high into a new price area, but you already have a position from step 4 at a lower cost with a profit cushion for protection. 5 advantages of pocket pivot. Entry 5 days earlier than a traditional breakout. Lower cost basis, profit cushion to weather post-breakout corrections. Less notice, especially effective in small cap low liquidity stocks. Institutional confirmation volume pattern shows smart money entering. Can be pyramided, add to position on a second pocket pivot or official breakout. Pocket pivot is not limited to base patterns. Once a stock has broken out and is in an uptrend, we can use continuation pocket pivots to add to a position. 4. Rules for a bounce off the 10-day MA. Stock is in an uptrend following a breakout from a base. Price bounces from at or just below the 10-day MA. Volume on the bounce day exceeds the highest down-day volume of the prior 10 sessions. Prior price action was quiet. Volume dried up during the pullback. The most important difference from a base pocket pivot, instead of using the 50-day MA as the benchmark, in an uptrend we use the 10-day MA. In a strong uptrend, strong stocks tend to respect the 10-day MA. Every pullback to it is followed by a bounce. That is a sign of strength. Now, we will talk about invalid pocket pivots. This section is critical. Not every pocket pivot is worth buying. There are 6 types of invalid pocket pivots to avoid. 1. Too far from the 10-day 50-day MA. The low of the pocket pivot candle must be near or just below the 10-day MA. If it's too far away, the stock is already extended short term and failure risk is very high. 2. Quick V-shaped recovery. Price drops sharply, then immediately rallies straight back up without sufficient time to digest the prior move. More consolidation time is needed. 3. Price wedges up before the pocket pivot. Instead of drifting lower quietly before the pocket pivot, if price is creeping higher, rising gradually on declining volume, the context is not constructive and the pocket pivot is prone to failure. 4. Occurs within a downtrend. A pocket pivot in a downtrend will fail immediately. Only buy pocket pivots on the right side of the curve, ideally above the 50-day MA. Even BIDU in the 2008 bear market failed every pocket pivot. 5. Wide and loose base. No systematic accumulation, no tight weekly closes. Pocket pivots in this type of base are unreliable. 6. Insufficient volume. If the pocket pivot day's volume is lower than the highest volume down day in the prior 10 sessions, it is simply not a pocket pivot. We'll walk through each example in order of the charts on the slides. The international examples from 1998 to 2009 are drawn directly from the book to illustrate the original theory. The Vietnamese examples from 2023 to the present demonstrate that the method can be applied directly in the Vietnamese stock market and that pocket pivot is a consistently valuable tool, not tied to any specific time period. VRSN 1998. This is one of the most classic examples in the Morales and Kacher book. The stock formed a cup with handle pattern throughout the summer of 1998. Heavy volume, a string of consecutive up volume days, appeared at the cup bottom, confirming institutional accumulation. Pocket pivot appeared within the handle. Price bounce off the MA area with volume exceeding the highest down day. This is a pocket pivot within the handle before the official breakout. Result, the stock broke out and subsequently rallied in a sustained uptrend. Investors who bought at the traditional breakout above $11 would have faced 2 powerful shakeout sessions dropping to near $9, a 20% decline. They could easily have been shaken out before the stock's real advance. Those who bought on the pocket pivot session had a profit cushion that allowed them to hold through the post-breakout correction. Potash Corp, March 2007, a textbook example of a pocket pivot bouncing off the 50-day MA in an uptrend. Pot traded sideways tightly throughout March 2007 with visibly drying volume. On March 30th, it burst above the 10-day, 20-day, and 50-day MAS simultaneously on very heavy volume. Ideal context, constructive flat base plus volume dry up plus sudden explosion. This is a pocket pivot within the flat base. Investors who bought here achieved a much larger gain than those who waited for the breakout at a price level near $60. The result, pot rallied more than 300% over the subsequent period, becoming one of the leading stocks of the 2007 cycle. Intuitive Surgical, April 2009, an example of a pocket pivot after a double bottom base. ISRG had fallen nearly 85% from its peak, a massive decline during the 2008 crisis. The market followed through on March 18, 2009, confirming the market was recovering. ISRG triggered a pocket pivot on April 9 at $103.75, Bouncing off the double bottom base, pocket pivot day volume clearly exceeded the highest down-day volume of the prior 10 sessions, and the result, ISRG rose more than 60% in just 4 weeks. By end of 2009, the stock had surpassed $300 from the entry at just under $104. This is the clearest proof that the pocket pivot can appear right at the true bottom of a downtrend. Before ISRG in 2009, BIDU in 2007 showed a similar pattern. Currently, in May 2026, the Vietnamese stock market has quite many stocks displaying formations similar to ISRG in 2009 and BIDU in 2007. Apple 2004, a classic example of continuation pocket pivots in an uptrend. AAPL had broken out of a base and was in a sustained uptrend. Each time price pulled back lightly to the 10-day MA on drying volume, then bounced on heavy volume, was a continuation pocket pivot. Investors could add to the position at each of these continuation pocket pivot. This is the approach to pyramid, buy more as the stock moves in the right direction. This example clearly illustrates the difference between a base pocket pivot to open a position and a continuation pocket pivot to add to a profitable position. First Solar 2007, an example of continuation pocket pivots in the booming solar energy stock. FSLR was the leading stock in the solar energy sector during the 2007 cycle. After breaking out from its initial base, FSLR repeatedly generated continuation pocket pivots on the 10-day MA. The volume pattern at each pocket pivot was clear, dry during pullbacks, explosive on the bounce. Leading sector stock plus strong market context equals highly effective continuation pocket pivots. The lesson here is not just about knowing how to enter a position, but also knowing how to add to it when the stock is winning. FT's 2023, after bottoming in November 2022, FT has recovered and then traded sideways in a consolidation phase. In March 2023, FT has formed a constructive base with tight closes. Volume clearly dried up on prior pullbacks. Supply was being exhausted. Pocket pivot appeared. Price cleared the 50-day MA with volume exceeding the highest down day of the prior 10 sessions. In the period that followed, FT has produced continuation pocket pivots. Interestingly, FTS's 2023 price behavior closely mirrors the first Solar 2007 US example we just reviewed, from the base pocket pivot to a first continuation pocket pivot that was shaken out, then a successful one shortly after. This is proof that the pocket pivot method can be fully applied in the Vietnamese stock market, where institutional accumulation leaves traces on price volume charts. DIG 2025. DIG fell sharply in early April 2025 during the Trump tariff Black Swan event. After bottoming in mid-April, DIG recovered and formed a cup with handle pattern. Volume in the handle portion was very constructive, declining steadily during accumulation, then exploded on the pocket pivot day. The first pocket pivot session had a long upper wick, signaling selling pressure still present. DIG then had a shakeout on lower volume than the pocket pivot day. DIG then produced 2 new pocket pivots before the stock rallied strongly. DXG 2026, the most recent case study in the Vietnamese series and a live example from the current market. DXG produced a pocket pivot as the real estate sector continued to recover after declining from September 2025. Constructive base, tight weekly closes, volume declining steadily during the consolidation accumulation phase. First pocket pivot day, volume exploded, price cleared the 50-day MA, confirming institutional accumulation. Second pocket pivot occurred after price retested the 50-day MA on very constructive volume. Let's watch together to see what happens with DXG going forward. There is one thing the book emphasizes heavily: context is everything. The context of price volume action before the pocket pivot determines its probability of success. You can memorize every technical rule of pocket pivot, but if you cannot read the context of price volume behavior, you will keep buying pocket pivots that fail. Good context. What to look for. Tight, quiet price movement before the pocket pivot, a sign that smart money is accumulating. Clearly dry in volume, no one is selling, supply is being exhausted. Stock outperforming the general market, a sign of relative strength. Market is in an uptrend or has recently had a follow-through day. Constructive base on the weekly chart, tight closes, no large swings. Bad context, what to avoid. Downtrend, stock and the index. Erratic, inconsistent volume, no signs of systematic accumulation. Stock underperforming the general market, a clear warning signal. Price wedging up before the pocket pivot, rising gradually on declining volume. Wide, loose, highly volatile base. Before buying on a pocket pivot, check the following conditions. Does the stock have strong fundamentals, EPS growth, strong revenue? Is the base constructive, tight closes on the weekly chart? Is price above the 50-day MA? Is pocket pivot day volume greater than the highest volume down day of the prior 10 sessions? Was price quiet and volume dry just before the pocket pivot? Is the low of the pocket pivot day at or near the 50-day, 10-day MA? No wedging up before the pocket pivot? Not a quick V-shaped recovery? Is the market in an uptrend or has recently had a follow-through day? Is the stock outperforming the general market? Not in a downtrend? Not extended too far from the MA? If all 12 points are satisfied, that is an extremely high-quality pocket pivot. Here is a summary comparing the core differences between the two methods to help you clearly see why pocket pivot is more effective in many situations. Timing. Traditional breakout buys at the highest point of the base. Pocket pivot buys within the base 2 to 5 days earlier. Awareness. Traditional breakout is known by the crowd, more prone to false breakouts. Pocket pivot is a more specialized technique known by fewer traders. Cost basis. Traditional breakout chases price buying high. Pocket pivot buys in the accumulation zone, optimal pricing. Risk. Traditional breakout is easily shaken out during corrections immediately after the breakout. Pocket pivot has a profit cushion, can withstand corrections. Conclusion. Pocket pivot lets you buy 2 to 5 days earlier at a lower price with less risk compared to a traditional breakout. That is why this method is favored by professional traders. We've just gone through the entire pocket pivot by point system. Remember these 3 most important keys. 1. Buy ahead of the crowd. Pocket pivot is not about waiting for a breakout and chasing it. It is the skill of reading institutional accumulation signals and entering alongside them at a lower price, lower risk, and with better psychology because you already have a profit cushion. 2. Volume is the key. One simple but non-negotiable rule. Pocket pivot day volume must exceed any down day in the prior 10 sessions. This is the unforgeable proof of institutional buy-in. 3. Context decides everything. A technically correct pocket pivot in the wrong context will fail. Train your eye to recognize context, tight versus loose, quiet versus volatile, constructive versus erratic. Thank you for watching this video all the way through. If it was helpful, don't forget to like, share and subscribe so you don't miss future lessons in the Stock Market Essence series. See you next time.